On January 1st, 2026, Warren Buffett was no longer the CEO of Berkshire Hathaway, but the system he spent more than 60 years building did not leave with him. Welcome to the channel where we turn the most important ideas about money, investing, and human behavior into clear visual stories you can actually remember. In today's video, we are breaking down 10 Warren Buffett rules that can help you think more clearly while building your first $100,000. We will look at how Buffett evaluates businesses, why he refuses most opportunities, how he reacts when markets fall, why he avoids dangerous debt, and why his most useful advice for ordinary investors may be much simpler than choosing individual stocks. Stay until the final rule, because it changes what investing like Buffett should mean for a person who does not analyze businesses professionally. Before we begin, if you want more researched visual videos like this, press the like button and subscribe to the channel. It directly tells us to keep creating this format. If you are building your first $100,000, these are the 10 Buffett rules worth copying. Not his stocks, not his wealth, his behavior. The final rule may also save you from believing that you need to become a professional stock picker at all. Imagine Alex has saved his first $10,000. The moment the money reaches his account, the market begins shouting at him. One video promises the next company that will increase 10 times. A friend recommends a stock that has already doubled. An advertisement offers leverage so he can make a larger investment without waiting. Alex asks the question most beginners ask: which stock will rise fastest? Buffett's system begins with a different question. What exactly am I buying, and what could permanently destroy my money? That question leads to the first rule. Rule 1: think like an owner. When Buffett and Charlie Munger bought stocks, they treated them as small pieces of real businesses. A stock was not a line moving across a screen. It was a claim on customers, factories, employees, cash flows, debts, and future decisions. So Alex looks at the exciting ticker again. He hides the price chart and asks, would I still want to own this business if the market stopped giving me a new price every minute? Would I be comfortable if I could not sell it for 5 years? If the answer changes when the chart disappears, he may not be investing in a business. He may be betting on another person paying more. Thinking like an owner slows the decision down. That is useful because the market is designed to make speed feel intelligent. Rule 2: know your circle of competence. Alex now finds a company operating in a rapidly changing industry. Its presentation is impressive. Its technology sounds revolutionary. But after an hour of research, he still cannot clearly explain how it will produce durable profits. Buffett's circle of competence does not mean knowing everything. It means knowing where your understanding ends. The size of the circle matters less than the honesty of its boundary. Can Alex explain how the company earns money, why customers stay, what could make margins disappear, and which competitor could replace it? If not, the correct decision is not to invent confidence. It is to pass. An investment you do not understand does not become safer because intelligent people are discussing it. Rule 3: focus on earning power. Understanding the product is only the beginning. Alex must also understand the economic engine behind it. Buffett has written about estimating a sensible range of future earning power rather than predicting the next market move. Does the business have repeat customers? Can it raise prices without losing them? Does growth require enormous amounts of new capital? Is debt supporting the business or hiding its weakness? A wonderful product can exist inside a terrible investment. If the company must constantly issue new shares, borrow more money, or spend every dollar simply to remain competitive, rapid growth may create little value for each owner. Alex is not searching for a perfect forecast. He is searching for an understandable engine that can keep producing value after the excitement fades. Rule 4: separate price from value. Then the stock falls 40%. Alex's first reaction is that it must now be cheap, but a lower price is not the same as a better value. If a business was worth less than the market believed, a falling price may simply be reality catching up. Buffett's approach requires Alex to estimate what the business can reasonably produce for owners over time, and then compare that value with the price being offered. The estimate will never be exact. That is why disciplined investors use a range and demand room for error. Price is visible. Value must be reasoned about. Confusing the two is how a bargain hunter becomes the owner of a permanently damaged business. Rule 5: prefer a strong business at a sensible price. A weak company can look irresistible when its price is low enough. Alex finds one with declining customers, heavy debt, and no clear advantage. The stock appears cheap compared with its history. Beside it is a stronger company with loyal customers, healthier finances, and the ability to reinvest profit. Its price is not obviously cheap. Buffett and Munger's mature approach favored the comfortable business at a sensible price over the questionable business that merely looked inexpensive. Quality does not mean buying at any price. It means recognizing that time treats businesses differently. Time can help a company with durable economics compound its advantages. Time can also expose every weakness inside a bad business. The purchase price matters once. Business quality keeps mattering after the purchase. Rule 6. Wait for the right pitch. Now Alex has a problem. Nothing he understands appears attractively priced. His cash sits still while other people post screenshots of fast profits. This is where activity begins to feel like progress. Buffett has compared investing with a baseball player who can wait for a pitch inside a small preferred zone. The difference is that an investor is not called out for refusing bad pitches. Alex does not need to buy because it is Monday, because he received a bonus, or because the market is open. He can wait. Patience is not the empty space between intelligent decisions. Patience is one of the decisions. But waiting becomes difficult when predictions arrive every hour. That leads to Rule 7. Rule 7. Ignore predictions you do not need. Interest rates may rise, inflation may fall, an election may change policy. A recession may arrive sooner, later, or not at all. Alex can spend every evening reacting to forecasts that will be replaced next month. Buffett wrote that when he and Munger made investments, macroeconomic and political predictions did not drive the decision. They focused on whether they could estimate the long-term economics of the asset and whether the price was sensible. This does not mean the economy is irrelevant. It means Alex should not build a plan that requires him to predict variables that experts repeatedly fail to predict. A robust investment can survive several possible futures. A fragile speculation requires one specific future to arrive on schedule. Rule 8. Treat volatility as an offer, not an instruction. Then, the market drops. Alex opens his account and sees several months of contributions disappear on the screen. His body interprets the red numbers as danger. The sell button offers immediate emotional relief. But the market price is an offer from other participants. It is not a command. If the business remains sound and Alex's original reasoning still holds, a lower price may improve the opportunity rather than damage it. If the business has genuinely weakened, refusing to sell can be as irrational as panic selling. The rule is not always buy the dip. The rule is to return to the business, the value, and the original thesis before reacting to the color of the chart. Temperament matters because the market repeatedly offers emotional decisions disguised as financial decisions. Rule 9. Never risk survival for a higher return. Alex receives another advertisement. Why invest $10,000 when borrowed money could give him exposure to $30,000? Leverage makes patience look unnecessarily slow. Buffett has warned that borrowed money can magnify gains, but can also turn one bad event into permanent ruin. Without leverage, a strong investment can fall temporarily while its owner waits. With leverage, the owner may be forced to sell before the thesis has time to work. This is why liquidity matters. Cash reserves may reduce returns during exciting markets, but they prevent ordinary emergencies from forcing extraordinary financial decisions. Alex's investment account should not contain money needed for rent, near-term bills, or emergencies. The first goal is not to maximize every possible percentage point. The first goal is to remain in the game. And that brings us to the rule most beginners do not expect from Warren Buffett. Rule 10. Most people do not need to pick individual stocks. Buffett wrote that most investors have not made the study of businesses their life's work. His solution was not that everyone should try harder to predict the next winner. For non-professionals, he described a low-cost index fund holding a broad cross-section of businesses as a sensible answer. He also emphasized accumulating shares over a long period, keeping costs low, and not abandoning the plan when the news becomes frightening. This may be the most Buffett-like decision Alex can make. He can admit that he does not possess an advantage in selecting individual companies. He can build a diversified, low-cost core and allow regular contributions and time to perform most of the work. If he chooses to research individual businesses, he can limit that activity to the small area he genuinely understands. Knowing that you do not need to swing is discipline. Knowing that you do not need to pick the pitch yourself is humility. Both can protect the first $100,000. The 10 rules now form one system. Own businesses, not symbols. Stay inside what you understand. Study earning power. Separate price from value. Prefer durable economics. Wait when nothing makes sense. Ignore predictions you do not need. Use volatility without obeying it. Avoid leverage. And if stock selection is not your profession, keep the core diversified, automatic, and inexpensive. Alex began by asking which stock could rise fastest. He ends with a better question. What process gives me the highest probability of avoiding permanent mistakes while time and contributions build the result? The first 100,000 is rarely created by one brilliant trade. It is more often protected by refusing the decisions that can reset progress to zero. So the Buffett principle worth remembering is not a stock tip. It is this: you do not need to be right about everything. You need a process that keeps you from being catastrophically wrong. Before you leave, if this source-based visual format helped you understand investing, press the like button. It tells YouTube that this is the kind of content worth showing to more people. And subscribe to the channel if you want more researched stories about investing, wealth, and the psychology behind financial decisions. We are building every new video to make these ideas clearer, more visual, and more useful than the last. Now I want to know, which of these 10 rules would be hardest for you to follow when real money is on the line? And if you want to understand why the first $100,000 can change the speed of wealth building, watch the video on screen now. It explains what happens when your money finally begins doing a meaningful share of the work.